Good afternoon, everyone. Thank you for joining us for what I think is going to be a really intellectually interesting and I think an important conversation about what future directions for the use of AI and machine learning and alternative data may mean for financial inclusion. I'm happy to be here, and thank you, NCRC, for inviting me to join this conversation today. I'm Melissa Coity. I'm the CEO and founder of FinReg Lab. FinReg Lab is a DC-based nonprofit research organization where we are testing empirically the uses of technology and data in financial services for purpose of driving a more inclusive financial system. I stood up FinReg Lab for a little bit of context after leaving the U.S. Treasury Department, where we were for at least 4.5 years, but it goes on even further, really inundated with questions around how does public policy evolve to enable the safe use of data and technology in our financial system, especially for the benefits of individuals and families, communities, and small businesses. And in many ways, seeking to answer those questions, what we really lacked was an entity that could help to generate fact-based information that would inform public policy and market practices, so that we really are taking advantages of where data and technology may help to bring more people into the financial system and ensure that more people, small businesses and communities are better served. And so we've got a really interesting conversation today. I'd love to invite the speakers who will be joining me to come on up, and we're going to start by opening up for quick introductions in terms of who you are and what you're doing in the context of AI and machine learning. And financial inclusion is a really broad topic. I think many of us, excuse me, I just swallowed a bunch of popcorn. Many of us are really thinking about the implications of AI and machine learning, especially in the context of credit. Credit is not just a necessity for bridging short-term gaps, but credit is also a really critical stepping stone for longer-term investments and wealth-building opportunities, whether that's the ability to acquire a home, start up a small business, and the list would go on. And so you're going to hear a lot about what we have been individually, but also I think collectively. In fact, a couple of us were just on a panel that we'll tell you about, really offering our insights about what the evolution of AI adoption and machine learning in particular, what that means in the credit context. So without further ado, I'm going to turn it over to Kareem. If you want to kick us off and let us know what you're doing in this area, that would be fantastic.
Yeah, thanks, Melissa. And thanks to NCRC for having me. My name is Kareem Saleh, and I am the founder and CEO of Fair Play AI. We help lenders increase the fairness of their marketing, underwriting, pricing, and collections models using advanced AI debiasing techniques. I've spent my whole career working on financial inclusion issues, in particular, how to underwrite inherently hard to score borrowers. I did that work at the German Marshall Fund, at an unfortunately named mobile wallet startup called ISIS, and for several years at the State Department and the Overseas Private Investment Corporation, as well as some other Silicon Valley-backed venture startups.
Fantastic. I remember ISIS of your type, not the one we all know. Didn't quite appreciate you were a part of that.
Mercifully rebranded Soft Card, yeah.
Yeah, excellent. Great. Eric, join us, please.
Sure. I'm Eric Sublett. I'm counsel at the civil rights firm Relman Colfax in Washington, D.C. Most of my practice involves advising financial institutions on best practices for complying with civil rights laws, primarily the Equal Credit Opportunity Act. And a lot of that, especially now, means evaluating discrimination risk in connection with statistical or more and more often machine learning models, both in the traditional lending space. But our work also increasingly involves working with financial technology companies and even online platforms to address those issues.
Oops, there I am. So our discussion is titled AI and Machine Learning, but as we were prepping for this session, one of the things that we talked about is let's really start to let some of the air out of the balloon and begin to get a little clearer about what we mean. And we'll use credit underwriting as sort of a helpful context here. What do we mean when we reference AI and machine learning as we think about credit underwriting? Kareem, do you want to share a little bit about how you think about that?
Sure. AI is just math. Of course, some kinds of math are more complicated and intuitive than others. So those of you who maybe took an elementary statistics class will recall that the formula for a logistic regression is y equals mx plus b. Relatively simple. Of course, today we have gradient boosted trees and neural networks and support vector machines. At the end of the day, these are just much more computationally intensive forms of math. They are forms of math that a human brain probably would struggle to understand and compute. But at the end of the day, they're just seeking to take data as an input, identify patterns in that data, and try to render a prediction about the question that's being asked, such as, will this borrower pay back a loan? What is the appropriate price? What is a price that is commensurate with the risk posed by this borrower that I should charge? Why don't I pause there and see if Eric has thoughts or comments or anything to add?
No, I think you covered it pretty well. I mean, we've seen artificial intelligence and machine learning applied to most, if not all, aspects at this point of lending. And for a while, you started to see it crop up initially, maybe in the fraud space or in the marketing space, but increasingly we're seeing it used for underwriting and other purposes as well.
Sorry about that. I seem to keep muting myself. There's a lot of enthusiasm, and I'll share. Kareem and I were just on an AI task force, House Financial Services hearing panel, where it was really notable how much enthusiasm there is in terms of what machine learning and AI, especially in credit underwriting, which we were focused, what that may offer in terms of financial inclusion. And we like to get into the weeds at FinReg Lab and really make sure that we are going to be able to understand how do these more complex, to your point, Kareem, math models, how do they work? But before we start to dig into some of that, because I think that gets really to many important issues around fairness questions that we want to talk about. But why is there such enthusiasm for how AI and machine learning may help to drive more access in financial inclusion? Eric, do you want to kick us off first?
Sure. So, you mentioned there was a lot of enthusiasm on the panel, and I personally tend to be kind of an AI optimist in the lending space as well. That's not to say there's no reason for concern, but I think on balance, for me, the promise outweighs the concerns. Certainly there are particular challenges that come with the use of AI, of machine learning techniques from a legal standpoint, from a non-discrimination standpoint. But at the same time, those very same methods, I think, offer opportunities to mitigate those risks and maybe to be more effective in reaching non-discriminatory approaches even than we had available to us in the past, whether that means effective ways of evaluating whether a model contains proxies for prohibited basis or more sophisticated ways to look for less discriminatory alternatives to a model that involves disparate impact risk. So while there are certainly ways for it to go awry, I think on balance, there's a reason for optimism and in terms of non-discrimination and greater financial inclusion. Yeah.
Kareem, before I turn it over to you, I'll just take the moderator's prerogative and share a few thoughts on this too. We tend to look a fair bit at what, and Kareem, you do, and I'm sure Eric, you do as well, at what some of the academic literature suggests what is happening and what the potential is in terms of the use of machine learning algorithms, these more complex math approaches to finding patterns, in this case for credit risk assessment. And the literature is somewhat mixed on this, but one of the things that really does come through is that so much of the potential power of machine learning and AI in credit underwriting for inclusion purposes really comes back to what are the data that you're feeding the math to begin with. And we at FinReg Lab had done some research, just even isolating questions around basic transaction data, inflow, outflow from a bank account, or it could even be a prepaid card, because we have higher incidence of coverage with bank accounts and prepaid cards than we do with traditional credit experiences. And we also have higher certainty of coverage with underserved communities and populations and minority populations. And so from an inclusionary standpoint, if that type of data is predictive, it actually might be quite useful from a financial inclusion outcome perspective. And so the research we did showed the cash flow data, and this isn't where did you shop or what time did you shop. It is literally the transaction information. Do you have a routine cushion in your account on a month-to-month basis? Does it appear that you are paying your bills on a routine basis month-to-month? But that kind of data actually was predictive. We evaluated loan level data of 5 fintech lenders who were using this information. And so bringing it back to the academic literature that's probing these questions of how inclusive might machine learning be, it does seem that one of the most important aspects of it is what type of data are we actually bringing into that math in order to credit risk assess populations who otherwise would be excluded. And I know, Kareem, you've spent a fair bit of time over your life thinking about different data and why that might be especially useful for inclusion purposes. I'd love to hear you share with the audience what you've seen and how you think about the importance of the data.
Yeah, thanks, Melissa. I mean, I think you raised 2 important points. One is the volume of the data, and the second is the kind of data. And so I think part of the reason there's tremendous optimism about machine learning is that, the traditional methods of doing underwriting, like logistic regression, can consume basically 20 to 50 variables. And if those 20 to 50 variables are present and correct, which they tend to be for super prime borrowers, let's say, then logistic regression does a great job of assessing your creditworthiness. The problem, of course, as you well know, is that something like 50 to 60 million Americans have credit data that's messy, missing, or wrong. And logistic regression fails in the presence of data that's messy, missing, or wrong. It gives wildly inaccurate predictions and usually disadvantages people because of its inability to kind of parse the nuances in their economic situation. And so I think part of the great promise of machine learning is that if you can move from a world of 20 to 50 variables to 500 or 1,000, it allows you to paint a much richer portrait of a borrower's ability and willingness to repay a loan. And we found that that's especially true for folks at the bottom of the economic pyramid, folks who, perhaps never had access to credit before, thin files, no files, recently arrived immigrants, folks who maybe had some kind of credit event in their past, like a bankruptcy or a foreclosure. So I think that's the great promise, is the ability to kind of consume more data. Now the question, of course, is, well, what kind of data, and is it really appropriate for assessing a person's creditworthiness, and where do we draw the lines? Fundamentally, and I've been doing underwriting for a long time, in my experience, when you underwrite a loan, you're basically trying to make an assessment of whether a person is responsible or not. And it turns out that you can find indicia of a person's responsibility in all kinds of places if you care to look. And I think the FinReg Lab research on cash flow data proves this, right? I mean, if you have the foresight to maintain a consistently positive bank balance, that seems to be a proxy for your level of kind of economic responsibility or maybe fiscal responsibility. You can get further afield. I mean, we have found, for example, that like the data from customer relationship management systems can be very predictive. So when you call into a call center, Why do you call? Do you call to tell the lender that you're going to be late with a payment? If so, do you call before you've missed the payment or after you've missed the payment? Turns out that there are indicia of responsibility in that behavior too. But of course, now you're into this behavioral realm where people start to get increasingly, I think, uncomfortable about, is this Big Brother or robots watching my behavior to make judgments or perhaps misjudgments about, my intentionality with respect to repaying a loan. So again, you got the volume question and then the type question. And the type question, I think, is where things start to get murky or uncomfortable when you start to get out of the domain of things that are very clearly related to creditworthiness.
Indeed, that's really helpful. And Eric, I'd love to hear your reactions on this matter as it relates to data. I know we're going to talk about fairness, and I'd like to probe even more on how you all think about the ability to have enough confidence in how these more complex models are working. But just before we dive into those, would be great to hear, Eric, how you think about, if you will, alternative data and alternative financial data and its relevance in the financial inclusion context.
Sure. I thought Kareem made some great points, and I just had a couple of reactions. One of them is that whether a particular data element, a particular variable might be appropriate or not, I think can depend on the particular context or type of decision you're talking about. So one thing that comes to mind is sort of like more granular, more specific data on shopping behavior. If you're making a general credit underwriting decision for, say, like a general purpose credit card, looking at the types of stores where someone is inclined to shop, I don't think that would necessarily be off the table, but I think you're potentially inviting some significant risk that the type of store you're considering might be a proxy for a prohibited basis. So say, for example, if the variable measures whether someone shops at a store that primarily sells women's clothing, for instance. On the other hand, suppose it's a model, and maybe it's not even an underwriting model, but it's a marketing model, and it relates to a credit card specific to that store. It's sort of like a private label credit card, for instance, or maybe a co-branded relationship with that retailer. If you're talking about a card that's specifically linked to shopping at that store, that might be a very different situation in terms of the appropriateness of using that type of variable. So I think it sort of complicates the question, but I think it's important to keep in mind that what might be a proxy in one setting may well be an appropriate variable in another setting. And then the second consideration is that, while I think in the first instance, when you're thinking of alternative data, it's important to keep in mind the question of disparate treatment, and to sort of have in mind a question like, is there an intuitive reason why this is predictive? Not necessarily because the intuitive reason something is predictive is sort of the ultimate answer to the question of whether a variable is permissive, but from a kind of a compliance management standpoint, it's an important question to keep in mind, because if a regulator is evaluating a model, it's the kind of question I would imagine they would ask themselves. But even where there's reason to be comfortable with a variable from that perspective, I think the sort of the disparate impact step of evaluating models is still an important one. I think we may be touching on that separately, so I won't say anything further at this point.
Yeah, I mean, it is an interesting, putting aside, I think, very important questions around proxies and how we evaluate, how we assess, and frankly, even some ideas that are being contemplated. Kareem, I'll put you on the spot later about this, but what do we do in light of the potential with proxy data? If you look globally, you will see that there are geographies where they don't have a credit bureau system, and there have been at least academic studies that suggest non-financial data, alternative data, may be really instructive for bringing people into access to credit. I'm not arguing for or against that, but I do think it's an important question in terms of, if there are places where there is lack of credit information, how do we think about what type of data may be useful for getting people that first toehold into credit opportunities? I feel like that's something we're really having to grapple with. Any thoughts about that? Putting aside, I know it'll be hard, Eric, but some of the legal considerations around that. You're only thinking about it from a legal standpoint.
Oh, I'm sorry. I thought Kareem was going to speak first. I'll do my best to set aside the legal standpoint. Particularly where there aren't other options, I do think that changes the analysis a bit in terms of what variables might be appropriate or acceptable. If you lack other options, I think the range of variables that may have a more kind of on their face attenuated relationship to credit, I think the case for them is stronger where there aren't as many options, because if the goal ultimately is sort of avoiding discrimination and promoting financial inclusion, you want to keep those options on the table, even while being mindful of the potential risks.
Kareem, I don't know if you had any thoughts about that.
My internet cut out for a second, but I agree. Look, I mean, the difficulty of underwriting new populations that are not well represented in the historical data is it's a real difficulty, and I think that you've got to kind of start trying to find sources that are as related to creditworthiness as you possibly can. And go from there. I mean, one of the great benefits of machine learning models, as I've said, is that they are resilient to data that's messy, missing, or wrong, and they can often do a good job of finding what are called lookalikes. So, I may have some dimensions in which I can understand Melissa, and I might not have a lot of information about your creditworthiness, but I might know that Melissa, along some dimensions, resembles her colleague PR or Kelly. And so maybe I can use, maybe the credit performance of PR and Kelly might be informative. As I get to know Melissa better, maybe I can start you off with a small loan before we graduate to a bigger one, so I can gather some data about your credit performance. In emerging markets, of course, there's been a little bit of a wild west in places like China, for example, where there was no traditional credit bureau, and you started to see the use of social media data and other types of data, which I think both led to tremendous overextension of credit, but also questions about kind of the creepy factor. And I think it's interesting that, in 2016, 2017, 2018, I think the rules in China were kind of anything goes. And now the Chinese government has even rolled a lot of that back because they've started to find some of these questions around the difficulty of these alternative data sets, alternative data sources, which are really far afield from creditworthiness. I think led to both an overextension of credit and also perhaps some other societal problems.
That does raise interesting questions around, and I think important questions that get now back to AI and machine learning, which is really understanding the data that you're plugging into your algorithms and how reliable it is and for how long. I haven't studied that, but overextension of credit, what was that due to? Were the data that were being fed into it insufficient for really, truly credit risk assessing? When we think about alternative data, and our focus has been on alternative financial data, but I think there are questions societally about how do we as individuals, and then how do we in this country decide what data feel appropriate to be used, even if it may be predictive, right? That's something we have to grapple with. At the same time, we do have laws with respect to the use of data in credit underwriting, yet we've also seen new types of data, such as cash flow data, are useful in terms of credit risk assessment. But we are in a place now of, well, how are we then making sure that consumers are sufficiently protected if we are finding data that we are societally comfortable with it being used in underwriting, but it hasn't been historically captured under something like the Fair Credit Reporting Act. So there are those kinds of matters that I think, industry advocates and others are really having to grapple with. At the same time, I think really contemplating meaningful consumer consent when this new type of data is being brought in is another piece of how are we sort of solving this puzzle about really taking advantage of, for the benefit of potential borrowers, the data, but making sure that they are well informed about how that data is being used and how that data ultimately is protected downstream. I don't know if either of you have perspectives on this data side of it, but would love to hear them. Kareem?
I defer to Eric, actually.
Okay.
Sure. Well, I don't think it covers the full sweep of what you're talking about in terms of consent to the use of various data sources. But I do think this is one reason that explainability or interpretability of models is such a key issue. Certainly there are added challenges in the machine learning space with being able to explain the basis for decisions. But I think precisely for the reasons you're saying, of making sure people are aware of how decisions about them are being reached and sort of what some of the key decisive factors are. I think that's all the more reason that the importance of explainability or interpretability needs to be kept at the forefront.
I don't know why I can't get myself off of mute. Let's now turn to the topic of AI and machine learning. Can either of you share what you're seeing in terms of what the financial sector is either using right now in terms of machine learning and credit underwriting or contemplating using? And then we can dig into some of the questions around fairness and adverse action notices and other expectations in terms of communicating to consumers and regulators, how those algorithms are working.
Yeah, I'll start, and then I'd love to hear Eric's views and yours too, Melissa. I would say that we are still kind of in the very early innings of machine learning's kind of takeover of credit underwriting. For the most part, I think lenders are still using traditional logistic regression-based systems. Sometimes what you'll find are lenders will use a machine learning algorithm to identify variables that are predictive and then plug those variables back into a logistic regression to try to enhance its performance. You can generate small performance gains that way, but nothing kind of on the order of using a traditional kind of full-blown machine learning technique. But of course, by doing that, you in theory get the benefits of the inherent interpretability of logistic regression. To the extent that lenders are using machine learning techniques, you have a wide spectrum. You've got, I would say most people are using a simple out-of-the-box what is called an XGBoost. This is a kind of decision tree. Decision trees are very commonly used in financial services. They are highly predictive, and they're kind of intuitive to humans because you sort of follow the forks in the tree and try to get a sense of why that gradient boosted tree, decision tree did what it did. Of course, the frontier of using AI in credit underwriting is not the use of any one single technique, but the use of multiple techniques in what are sometimes referred to as ensembles. And in that case, you may use a gradient boosted technique, but some of these other more advanced techniques that folks I'm sure have heard about, like neural networks, which attempt to replicate the computational systems and power of the brain, or support vector machines or kernel methods. The most advanced lenders are using 5, 10, 15 different techniques, sometimes all ensemble together to enhance the predictive power of their credit underwriting models. There are very few people who are able to do that, in part because explaining those complex ensembles really is both kind of an art and a science, and there are very few people who are capable of doing it. But so I would say we're still kind of in the early innings. It's still pretty basic elementary stuff. But as lenders come up the curve and kind of squeeze all of the juice out of those low-hanging fruit techniques, I think you will see over time, a tendency to use some of these more complex ensembles. And of course, there are a number of questions that arise from the use of those ensembles that I'm sure we'll talk about in greater detail.
I think what I've seen sounds pretty similar to what Kareem's described, and I share the view that this seems like relatively early going in the adoption of machine learning techniques. I think maybe for a few years now, I've seen relatively widespread use of machine learning in the kind of for marketing models, for fraud related models, and I agree those tend to be more tree-based machines of one type or another, whether that's a gradient boosting technique or random forest or something along those lines. I've seen relatively little in terms of the use of something like an artificial neural network, convolutional neural network, especially on the underwriting side. I think that's still pretty unusual in my experience. But I think is particularly as the explainability techniques become more sophisticated, I think that tends to be one of the bigger hurdles there. And as those further develop, I suspect we'll see more of that.
So those range of algorithm types obviously range from more explainable to more complex. I think I would largely join both of you in sort of what you're seeing. We are also observing, and I don't think it's surprising, that there are definitely some of the larger banking depositories who, will argue we should not be putting a black box on top of a black box. We should be building explainable from the start, and that's how we go about doing it. From a research standpoint, with ambitions around fairness, which I promise we're going to get to, but also inclusion, we're asking the question, and actually this question came up in the hearing that we were just a part of, well, what are you giving up in terms of accuracy? What's that trade-off in terms of inclusion? But really importantly, with the more complex models, how explainable are they, and what confidence can you have in what the explainability techniques offers? So that's something that we are looking at. But let's talk about fairness. Eric, do you want to kick us off sharing where we're starting in terms of legal definitions of fairness expectations? And then Kareem, it would be great to hear you, because I know you've been following academics, computer scientists, consumer advocates, really beginning to contemplate new ways that maybe we should be thinking about defining fairness, and then contemplating how we go about achieving it, and how are we even articulating metrics in terms of evaluating for fairness. Eric, do you want to start?
Sure. So the fairness conversation, I think, is a really rich and interesting one, and it's been, I think, in some ways felt like it's almost going along in parallel tracks in sort of the computer science community and more in maybe the legal community, though I think increasingly there's sort of kind of cross-pollination of those conversations. I remember I went to a conference a few years ago, and I saw a really good presentation that was titled something like, 21 definitions of fairness. I was like, oh wow, that's a lot of definitions of fairness. That said, I think in the current legal framework, the primary ones, certainly not the only ones, but the primary ones, and those we advise our clients to keep sort of first and foremost in mind are still our discriminatory treatment and disparate impact frameworks. So avoiding using prohibited bases and also close proxies for those prohibited bases, and also ensuring models are evaluated for disparate impact, and where there is disparate impact, checking for less discriminatory alternatives. That's not to say there's not relevance to other notions of fairness, things like differential validity, differential predictiveness. It's more though that I think those concepts can be either fit within maybe step 2 of the disparate impact framework, or potentially even as part of the treatment framework. But I think for the time being, and some of this just has to do with sort of where the authority is, and sort of where there's precedent for how to think about these things most clearly in terms of case law and regulatory materials. Our focus at this point is first and foremost on treatment and impact questions.
Kareem?
Yeah, where to start? So definitions of fairness, they are hard, right? I mean, let's put lending aside for a moment, right? Let's talk about, my favorite subject, which is pie, right? There's one definition of fairness is everybody gets the same size piece of pie. And another definition of fairness might be, well, I worked harder, so I should get more pie. And everybody, depending on where you sit on that.
Sounds like my dinner table conversation with my 3 sons, by the way.
And so, part of the difficulty we have is that in consumer financial services is that everybody has a definition of fairness that they prefer, right? I mean, the regulators have been very clear, and consumer advocates, and I think it's the right definition, have been focused on demographic parity, right? Like, what fraction of protected groups am I approving, for example, relative to control groups like white males? But some lenders prefer a definition of fairness that is like equal odds, So, look, I approve everybody who's got a credit score above 700, regardless of whether they're, white, black, green, yellow, what have you. Of course, the problem is that most minority groups are, depending on where you set that, credit score cutoff, you may be leaving a lot of historically disadvantaged groups, out of your lending program because they haven't had the same opportunities to earn a score of 700, 750, whatever it is. I think this is one of the areas where it would be good for the regulators to kind of update their guidance. I don't think there's been updated guidance from the Bureau, if I'm not mistaken, since 2015 or 2016 around how to calculate some of these definitions of fairness, whether it's, odds ratios or marginal effects. Demographic parity is well understood. But I think as an industry, we need probably some more guidance on which definitions of fairness ought to be tested and what are the fairness thresholds, right? So the employment domain, for example, it's very clearly stated that if you're looking at, demographic parity, that a lender or an employer is safe if they employ 80% of the minority group applicants that they do of the control group. There is no similar fairness threshold in financial services, and that's probably an area where it'd be useful to have some updated guidance. The other question I know that you're interested in about fairness, Melissa, is this question of, is there a fairness penalty? Or do profitability and fairness necessarily exist in tension to one another? The short answer to that is that there certainly can be, right? I mean, if you've built an algorithm that has been trained to optimize for profitability, it's going to do a bunch of things on the way to optimizing for profitability that you might not have otherwise intended. And by definition, if you go back to that algorithm and say, hey, in addition to profitability, I now want you to optimize for fairness, the addition of that second consideration will, by definition, perhaps lessen its tendency to optimize on the dimension of profitability. Now, I think the other the counter argument to there must be a fairness penalty is, well, the data is not really representative of these historically underprivileged groups. And if you upsampled, black borrowers, if you upsampled disabled borrowers and had more examples of how they performed from a credit perspective in the data, that you might actually not incur a fairness penalty. You might actually find that it's profitable to lend to those historically disadvantaged groups. And that's been the argument made by a lot of fintechs, including one that joined our panel before Congress this morning.
If I could jump in briefly, I think the point that Kareem just made about sort of the trade-off in some ways being an artifact of underrepresentation in the data is a really important one. I think there's another factor that potentially, I don't know that it entirely kind of eliminates the trade-off, because as Kareem said, if you go from not having a sort of a second consideration to adding that second consideration, that's going to have implications. But the other reason is just because even if there is some trade-off, there's a question of the magnitude of that trade-off. And I'm going to forget who the phrase is originally due to, but this idea of kind of a multiplicity of good models. And it could be that even if your starting point, let's suppose it is the best model, it could be that there are a lot of other models that are really, really, really close. And it's one thing to say that you shouldn't have to give up some considerable amount of model performance in order to mitigate impact. And indeed, I think that's consistent with the disparate impact framework, is that a less discriminatory alternative that is not similarly effective from a business standpoint doesn't need to be adopted. But if you do have these models where the distinction in performance is really, really small, then I think that's another matter entirely. And I think kind of one of the reasons that I am an optimist in terms of machine learning is because I think that the machine learning techniques are one of the things that facilitates identifying all those models and all those subtle variations that are nearly as good from a performance standpoint, but may nonetheless make a big difference in terms of impact.
I'm really glad Eric mentioned that. It turns out that you can there's even with the same data sets, you can achieve a much greater level of fairness generally at very low cost.
Yeah, we wondered about that, right? I mean, if your math and your data are yielding, much greater prediction accuracy, where are you finding the alternatives in? Are they sort of landing you close to what your options are then? There are also some big ideas out there about if we might be driving, it comes back to inclusion, but inclusion as a form of fairness, given the sophistication of machine learning algorithms and the fact that many would argue they will find proxies in data that the human would not have necessarily picked up. Would we be generating better models and potentially extending credit to populations, if we were actually to allow protected class information into those models themselves? Would love to hear you all opine on this kind of idea. It came up by some of the academics when we were doing the cash flow research. And the point that was made to me is, Melissa, if we were comparing you with all women, given the income differences between men and women, we might be letting in more women in terms of access to credit, as a very simplified way of making this point. Just curious, how you all sort of perceive that kind of idea, where the potential benefits are, and goodness, we have these prohibitions on using that kind of data for very good reasons. How would we actually continue to make sure that we don't have abuse if we were to put those data into the models?
Yeah, I'd be keen to hear Eric's view. I mean, my view is that this is one of the toughest questions facing us as an industry right now. I think for very good reasons, as you know, we do not permit the use of race, gender, age, et cetera, in underwriting, largely because those prohibitions largely emerged out of an era where underwriting was judgmental. And I think there is an increasingly rich literature about what's called fairness-aware machine learning that suggests that the inclusion of that protected information would increase the accuracy of some of these models for subpopulations. And so, on the one hand, I understand, and I struggle with this personally, which is why I'm keen to hear what other smart people like Eric and you think. But, on the one hand, I would feel deeply uncomfortable if I went to apply for an auto loan and I was asked, what my race was. On the other hand, I think there's no question that, if I could get a better rate, if you could approve more folks like me that have maybe been left out of the system, if you can prove that you're using that information for a salutary purpose, maybe we ought to permit it, or at least permit it subject to, certain strict, guide rails.
Yeah, I agree. It's a tough one. I have some familiarity with that literature, and I'm really glad that work is being done, because I think it's good to be open-minded about things that can make the financial system more inclusive. I do have a lot of wariness of it, just because it seems like there's so much room for that information to be misused, and certainly a long way from where we currently are. So I guess that's something I'm kind of keeping an eye on with interest, but I think it's a ways. I don't know. It makes me kind of nervous. I think there's a lot of ways that something like that could go wrong, but I'm glad that thoughtful people are thinking about it and writing about it.
Yeah. Adversarial debiasing. Kareem, can you tell us what in the world that means and why we should all be thinking about it? Oh, you're muted.
Sure. Adversarial debiasing is one of several new techniques that has shown a lot of promise for increasing the fairness of machine learning models. There are two examples that I like to use when I describe how adversarial debiasing works. One involves a cop and a counterfeiter. And imagine you were a counterfeiter trying to pass fake bills by a cop. And so you go into your little counterfeit lab, and let's say you've got three variables to play with. You've got the ink, you've got the paper, and you've got the typeface that you're going to use to make fake bills. I hope there's nobody from the Secret Service on this call. And so you kind of you use the ink and the paper and the typeface you've got, and you give that fake dollar bill to the cop, and the cop immediately recognizes it as fraudulent. So you go back to your lab and you play with those variables a little bit more. Maybe better paper, different ink, a more accurate typeface. You basically reweight the composition of the variables to try to produce a better counterfeit bill, and go back and present it to the cop. And the cop and the counterfeiter go back and forth in this cat and mouse game until one day the counterfeiter has adjusted the composition of variables relative to one another just right that the cop is no longer able to discern that the bill is a fake. So to apply this, to use this kind of in a lending context, you could imagine a credit model and an adversarial model, where the credit model is underwriting borrowers, and the adversarial model is constantly trying to predict, on the basis of the data that credit model is using, is this borrower black? Is this borrower a woman? Is this borrower over the age of 65? And if that adversarial model is able to predict with a high degree of accuracy the protected status of that borrower, then you need to stop that model and understand what variable interactions are leading it to be able to predict that this borrower is a member of a protected class, and then of course adjust your variables accordingly so that you can no longer discern whether that borrower is a member of a protected class, while at the same time not compromising the overall predictive power of the model. I know I've said a lot, but one other example that I find useful to understand adversarial debiasing is, imagine a robot holding a Coke can, and you're trying to knock the Coke can out of the robot's hand. In the first few instances, you may be able to knock the Coke can out of the robot's hand, but the robot will continue to adjust its grip. That is to say, play with the various variables, which are its digits, and try to adjust its grip. And you go back and forth, trying to knock the Coke can out of the robot's hand, until one day the robot understands exactly the right way to hold that can, and you're no longer able to knock it out of its hand. At that point, the robot has understood what composition of variables it needs to do in order to frustrate your purpose.
Eric, how do you hear that kind of approach?
I don't know that I have a whole lot to add to Kareem's explanation there.
Yeah. I like the robot example better, Kareem. It's I can get my head around it. There's a lot here, and there's a lot of math and a lot of sort of competing algorithms. What do we all need to know? We as people who are engaged from a policy standpoint, from, imagine if you're a small bank and you're thinking about, partnering with a vendor. How do you get your head around this to have a level of comfort with the adoption of machine learning and AI in underwriting?
Eric, please.
Sure. I think one thing to keep in mind is that in some ways it's very different, but in other ways it's really not that different at all. And there's sort of the same non-discrimination principles from the Equal Credit Opportunity Act apply. The same obligations about providing adverse action notices apply. The fact that the computer is more sophisticated in how it uses data to generate an outcome doesn't change the fact that a lender is responsible for meeting its obligations under the Equal Credit Opportunity Act, under Regulation B. You can't really just sort of like defer responsibility to an algorithm when as an entity you've decided, you've built that algorithm, you've licensed that algorithm. However you've come to employ it, it's still kind of ultimately down to a lender to ensure that they're using these things responsibly. So in some ways it's things have changed, but in many ways they really haven't.
Yeah, I agree with that. I mean, at the end of the day, as lenders, you still have to run your model governance process, and you still have to ask the same basic sets of questions, right? Which is, how is this model making decisions? What variables is it taking into account? To what extent have I done everything in my power to make sure that it's not making decisions on some prohibited basis? Now, what becomes, I think, more difficult is there's a little bit of a learning curve with respect to the new. It's harder to answer those questions if you've never dealt with, a machine learning model before, or a machine learning model's explanatory technique. And that's where, if you're a lender without a very sophisticated data science team, it can make sense to partner with outside companies who specialize in doing this work. Although I have a tremendous amount of sympathy for lenders, because there are a lot of companies who claim to be able to do this work who don't do it very well.
Yeah, I've thought about this frequently. There is comfort in the fact that in the financial sector, we actually have very explicit laws that demand evaluation for fairness, non-discrimination, communicating to the consumer, especially if a decision was reached in terms of, a credit outcome that you didn't expect, an unfavorable outcome. And importantly, even on sort of the prudential side, right? Safety and soundness, you've got to be minding those models. You have to sort of evaluate for reliability. And that is something that is true. And frankly, you don't see similar requirements, legal requirements in other sectors where there is hard grappling with adoption of AI and data and what's used. At the same time, I think this focus on AI and machine learning and the potential of data and the 60 million US adults in this country who are not being credit risk assessed under traditional means, there's a need to sort of poke at this a little bit. Do we have it right? Are there ways that we can be doing it better, either in terms of safely bringing in new types of data, but then also contemplating how this, as I like to call it, fancy math, might actually be really useful for greater financial inclusion. And so I'm curious if you all have thoughts on sort of how we're going to, go from where we are. Great that we've got protections in place, but the financial sector is so critical for equity. We didn't use that word, right? But it is essential for how we're building wealth and opportunity over the long term. How are we going to evolve? Because the math and the data may offer us some really more equitable outcomes if we can do it safely. Curious how you all see us evolving. And hopefully there are a few regulators listening too.
I think of predictive models as occupying a spectrum, basically from coin flip to crystal ball. And at every point on that spectrum, you've got a predictive model that will decline some borrowers that it should have approved and approve some borrowers that perhaps it shouldn't. And as you get closer and closer to crystal ball, those errors are minimized, and more people who ought to receive credit are awarded that credit. And the good news is, we're still so early in the adoption of these technologies that we could still realize a lot of inclusion just by upgrading people from logistic regression to XGBoost and using some of this low-hanging fruit that you all at FinReg have identified in terms of data, whether it's transactional data or trended data. There is a lot of data that is clearly related to creditworthiness and a lot of machine learning models that are fairly interpretable. And if we could just get the industry to take a baby step in that direction, we'd be doing a lot of good. And that's before we have to confront, obviously we should always be mindful of the fact that there are a number of difficult questions in this arena, but there's also a lot of low-hanging fruit. Let's go get the low-hanging fruit and see what we can do.
And to that end, I think it's worth giving a shout out to the regulators who have issued a statement talking about the potential of alternative financial data for inclusion purposes. And then, of course, the team at the OCC has been really charging ahead with Project Reach, Operation Reach, Project Reach, really trying to think about inclusion opportunities there. Eric, would love to give you the last minute, how the world is going to evolve.
I'll take the last minute, I suppose. I agree with Kareem. I think that this is all pretty new, and I think it's all changing, and I think generally improving pretty quickly. I think it's heartening. The regulators have been trying to learn a lot, and I think they're that we've seen multiple RFIs from the CFPB and more recently others. And I'm optimistic that'll lead to some additional guidance, but hopefully guidance with remaining room to explore and innovate. I think there's the conversation around this is expanding too. I think in the kind of the machine learning literature, there's a much greater attention now to fairness, or at least there's sort of maybe more awareness on the part of people like me, kind of working more from kind of like an industry perspective of that, the fairness dimension of that literature.
Yeah.
Whether that means additional data, additional techniques, or even making sure that, sort of you see diversity among, the people researching on this, or the development teams, and just sort of the importance of this being kind of an inclusive space, not in terms of financially, but in terms of how we think about, effective development of these models and what fairness looks like in just that conversation. But I think things are moving in a positive direction.
Great. Well, thank you both. I hope this helped to give some sense of what we mean when we're talking about AI and machine learning in credit underwriting, but especially for financial inclusion purposes. It's been a pleasure talking with both of you, and thank you again, Adam Rust. It's really a joy to be able to join you and host this conversation. So thank you.
Thank you.
And Brad Blauer too.
Yeah, thank you, everybody.